Okay, I'll reset this again. So I hope you can hear now. Amazing, amazing, amazing. So we begin here. So what I was saying is there are a lot of schemes that lenders themselves, due to they being in the market, try as much as possible to put in place to help buyers of property. So that's some that we're going to go into more details today. Basically, the agenda is to go through who we are, the schemes, questions, what next, and then we will close. This webinar is brought to you by the Rock Financial Management Companies. We are independent financial advisors. We are registered with England and Wales, and we are authorized and regulated by the Financial Conduct Authority under this reference. It doesn't mean that we don't do mortgages or we don't advise clients in Scotland. We do as well. So for us, we pride ourselves in putting our clients at the heart of everything we do, and we develop long-term relationship. We try as much as possible to understand our clients' needs and try and implement solutions that fit them, that address those needs. And we are very friendly and approachable. So, yes. Some of the things we do, we provide holistic financial advice to clients on savings and investments, mortgages, protection, general insurance, pensions, auto enrollment, long-term care, equity release, wills, and trust. So these are some of the things that we advise on. So who you are seeing today is a different person, not a different person, it's the same person with a different hairstyle. My name is Narian. I have my certificate in mortgage and advice and practice from the London Institute of Banking and Finance. I have my master's degree. I have my bachelor's degree in accounting, and I'm a chartered accountant with ICA GH. I'm also a mortgage and protection advisor. I've been doing mortgage and protection advice for, I would say, the past 5 to 6 years plus now. So just a basic introduction with this one is that most banks or lenders, we say banks or lenders because not all the people who give loans are banks. They are building societies, and there are some other lenders who are not banks. They have different policies and different criteria. I think that will be a basis point for us. Different policies and different criteria means that if someone says something about income, another person will say something else about income. It doesn't mean that everybody is going in the same direction. It's a very competitive market. So everybody wants people to come to them for their mortgage because that's how they're going to get money, isn't it? To pay their staff and to be in business. So they go about their policies differently. What their risk appetite is, that is what they do. Now, and so as individuals, as people, every circumstance, we look at which lender will fit your criteria. So the disclaimer here is that what we have put together is not from one particular provider, it's from a different lenders. So that's something that you should bear in mind. And note that what we are doing here is not financial advice. If after going through all that we are going to go through, you think one of them resonates with you or will fit your criteria, speak to us, and then we go into details and make sure that indeed you meet their criteria, and then take it forward from there. Okay. So the first one on the market or the lenders have is what we call first time buyer boost or income plus. Basically, what this means is that on a normal circumstance, when you are looking for a mortgage, there's something called loan to income, and there's a maximum that your income can get you when it comes to a mortgage. And I know in the market, a lot of people know about 4.5 or 4.49. But for first time buyers, some of the lenders have increased this loan to income to 5.5%. So that is something they are doing for first time buyers. So they are able to get a lot of money, because the challenge is a lot of first time buyers are not able to buy their own homes. And so lenders are trying to put in place things like this that would help them to buy their own home. And so to qualify for this 5.5, you must be a first time buyer, or if you are you're doing the application jointly, you have to at least one person should be a first time buyer. And the total income at least should be 40,000 or more. And then for this particular scheme, it's 90% or less loan to value. There's another one called Income Plus. So Income Plus accepts self-employed people, and that's up to 95% loan to value, including new built houses. And so they multiply. There's not a minimum income like the first time buyer boost, but any income you have, they would do a cap of 5.5, for the household income, and it's up to 95%. So if you're looking for that means you have to have 5% deposit. There's also something that is called joint borrower sole proprietor. So when you look at this illustration here, there are two people. The two people would go for a mortgage, which is the document up here. And what happens is, although the two of you are on the mortgage, only one person would own the house. So both of you do not own the house. What mostly they do this to get, let's say, someone to help you to buy your house, a family member, I would say, to be on the mortgage with you, but they won't own the property with you. So the mortgage would be with a lender. When it's being registered at land registry, only one person's details will be there with land registry, and that person would be owning the property, not the two of you. Yes, and with this one, this policy can accept 4 people. So 4 people are on the mortgage, but you decide who is going to own the property. And there's no restriction. This particular policy, joint borrower sole proprietor, is a lot of the banks do it, but each bank has their own criteria. So this is one lender saying that they would accept 4 people and 4 applicants. There are some lenders who do the same thing, but they would only accept 2 applicants, for instance. So depending on your situation, then we see which lender fits your criteria and which lender also has a good rate that will help you. So there's no restriction on the relationship, but some lenders also restrict you to just family members. And this one is available up to 95% loan to value. So this one you need to have at least 5% deposit to be able to do this joint borrower sole proprietor with this particular lender. Other lenders also call it family-backed mortgage. Family-backed mortgage, yeah. So that is that with the joint borrower sole proprietor. If you have any question, you can put it in the chat and then we can look into it. So another provider also do this one as well, and it's up to 2 households occupying or supporting them, up to 4 applicants as well, no more than 2 applicants in each household, and all income considered for all applicants. So if, let's say, and they're saying that the relationship of the occupying household needs to be parents, grandparents, grandchildren, siblings, spouse, civil partners, uncles, step relationship are also, and in-laws are also accepted. So what happens is if you have, for instance, an uncle, and the uncle has good income and they can be on your mortgage for you, then they can join you to buy the house, but your uncle will not own the property. Know that their credit report, their debt, everything will be taken into consideration for the mortgage, just that the property would not be owned by the uncle. Some lenders say that they expect the uncle to have had their own homes already. So some lenders have that criteria as well. Yeah. And there's another policy or scheme that is called Family Assist. So this product allows lending up to 100% of the property, but they need a security collateral that is equal to 20% of the value of the property being purchased by a family member, either in cash or in equity of the family member's home. So with this scheme, you have the property you want to buy, let's say 200,000, and your family member wants to help you to buy. They can either put in cash savings, the savings, which is the option 1 here. So the family member places their savings into a family security account, which earns interest. The savings act as security for 5 years. The account is opened individually, and a maximum of 4 accounts can be opened. So they will open a bank account with this lender or this bank and put in the 20% of the house you want to buy in that savings account, and that account continues to earn interest. After 5 years, then they can take their money. Or they can also use their own home. So the second option is the family member provides a collateral charge over the home, over some of the equity in their home, which acts as security. So if you have a family member who has a home with no mortgage or very low mortgage, and they can get equity in the property for 20%, then they can also do that. And it can be a combination of the two as well. So let's say you want to buy 200,000 property, the percentage deposit is, let's say, 40,000. Your family member has just 10,000 cash. They can put it in the savings account, and you don't have access to the savings account. The money is for them. And then the equity on their property will be 30%. And then 5 years time, they can take off the charge from their property. So the collateral charge remains in place for 5 years, and then they can take it off for them. There's also another family assist scheme that is called concessionary purchase. So this transaction mostly is between close family members, and the list of these members are there. or it can be between private landlords and their tenants, so far as you've been a tenant of the property for about a year, or an employee buying from their employer. What this means is that the person who owns the property, whether your landlord is who is willing to sell the property to you, could say, okay, I'm going to gift you some of the equity in the property for maybe 10%. So they give you 10% discount on the property, but they still sell the property at 300. Now, if they are gifting you the equity, then that's 10%, then it means 30,000 will be your deposit. And then you go for the mortgage of 270. Concessionary purchase criteria differs from bank to bank. So that's what I'm saying. Some of them will allow you to borrow the 270 straight away without you evidencing any deposit at all. Some would also ask you to put at least 5% deposit on the 270. So it depends on the lender that your criteria fits in. We'll be able to see. So this is the concessionary purchase. So for instance, if your mom or your dad, they have a property they want to sell to you, you don't need a deposit. They could say that they are gifting you some of the equity the property has as deposit. How that works is that we would apply for the mortgage in your name, you buying the property, and your parents or your relatives would be the sellers. And then the deposit is coming from the sellers giving you, gifting you some of the equity in the property. I hope this is clear. There's also professionals mortgage for fully qualified, registered and practicing solicitors, barristers, medical doctors, accountants, actuaries, vets, dentists, surveyors, architects, and engineers. So if you are qualified and registered practicing this particular scheme do 6 times your earned income. Right. So, but you need to be 21 years, and all applicants will be on their mortgage, and you should be qualified for the last 10 years. The reason why the 6 times is the catch in this case is that if you want to buy a property worth of, let's say 400,000, and your income, the bank's income multiple is 4.5. They won't go beyond that. Even if you can afford it or more, they won't go beyond the cap of what their loan to income is. So once they are flexible, let's say they can go up to 6 times, then it gives you more loan than the others. That is what this professionals mortgage is all about. So as I'm saying, if you have any question, you can put it in the chat, and then because you can't unmute to say anything, you can put it in the chat, and then we can answer your questions. There's also the popular 100% track record mortgage. What this mortgage is about is that, when you rent and you've been able to rent for, let's say, the past 3 years, paying a particular kind of rent, this scheme is saying that if you've been able to pay this particular kind of rent, it means that if we give you a mortgage that is paying a monthly amount of at least your rent, you can pay. So they are trying to use your rental payments to give you the mortgage. And so with the track record mortgage, they need you haven't owned a property for the last 3 years. You have a track record that all your monthly rent has been paid for the last 12 to 18 months. If you have a deposit, you can still put it in there. They are happy to take even deposit that are gifted as well. But so you can borrow at least 100%, but it's subject to affordability. What that means is that although you can borrow 100% of the property, your income and everything should be able to afford it. That is something that we need to be mindful of. And the loan to income, as we are saying, this one is 4.49, and the maximum term is 40 years. Okay. Discounted sale. So there are also some kind of affordable housing schemes that local authorities also do for their people. So local authorities can say that they are, I think this one is not a lender, but mostly is the local authority. But the lenders agree to it, that you want to buy a property from the council or from the housing association or from a particular developer, they would reduce the amount of the house and say that we've discounted this property 10%. So you can buy the property at 90%. What that means is that you go for a loan on the 90%, but the obligation here is that when you are selling, you also need to pass on the discount to the next person. And so there are some clauses that the lenders want to see. For instance, if you are not able to pay and the lender wants to sell the house, are they also obliged to pass on the discount? So this is one of the things. But yes, some of your local authorities, they have this as well for you to know. If you can hear me, can you send me some form of emoji on the chat? Can you let me know if you are still here? I want to confirm that you can hear me okay. I will wait for a minute to see. Or send something. Okay, you're saying you can hear me. That's good. Okay, there's another one also called Family Springboard. It's similar to one of the ones we've talked about. So this is a helper who put 10% security deposit in a helpful start account, and the applicants are able to purchase the property with no deposit or at least 5% deposit. So this as well, you need to, whoever wants to help you nowadays, when you go to somebody to give you or gift you, your relative, they should gift you 10% of their monies for you to buy your home. It might sound like, what work have you done for me to give to you that amount? But what they can do is not to give you the money per se, but they will put their own money in another bank account with the bank. And then after 5 years, they can take their money. I think that is one of the good things there. They can take their money after 5 years. So they have the money they put in the account is also earning interest. So they get to go home with some form of money. So yeah, they contribute 10% and put it in the savings account, and it's for LTI or 4.49 depending on your income. The maximum loan they can give you is 500,000 and the maximum term is 35 years. is for first-time buyers, and the repayment will need to be capital and interest. Interest only on residential will not be accepted. Yeah. There's something called Forces Help to Buy. Help to Buy. We don't know who is here or if you have any relative in the force. They give them a 10 years interest-free loan up to £25,000, and that loan they accept it being used as deposit. Note that with your deposit, you can't go for a loan to serve as a deposit. And even when you go for a loan, the monthly payment is used in calculating affordability. So it makes it counterproductive that you are using you need a deposit, but then you because of the loan you can't get the mortgage you are going for. So that is something that you need to be mindful of. So this Forces Help to Buy, they give them 25,000 and they use that amount to serve as their deposit to buy their homes. Helping Hands. So Helping Hands also help first-time buyers who could to borrow 6 times their income as well. And it's available for 95% LTV on 5-year fixed product and 90%. There's also cashback of £500 or more if your property is energy efficient. The minimum income is 30,000 sole applicants or 50,000 for joint borrowers. They accept all sort of incomes, but they don't accept self-employed income. So sorry, my self-employed people, Helping Hands is not the one for you. But there are other ones that accept self-employed. The catch here is that, as I was saying, 6 times your income means that you can borrow more. That's why they're saying that you can borrow at least 33% more for the property. Rent a room. Rent a room. Are there any single individuals on the platform? Give me a shout out if you're single. Send me an emoji if you are single. So Rent a Room lets applicants, mostly single applicants, they allow you to rent a room to someone. Now, how this works is that when you are buying the property, which we've done before, when you're buying the property, you would estimate how much the room is going to go for. And definitely it can't be a 1 bedroom, right? It needs to be at least 2 bedrooms where you would rent the 1 room to someone. And then they use that rent you'll be getting to add to your income. That may boost your income to get more, to get more loan. So ideally, when you are going to buy on a normal circumstance, you just with your income is what is considered. But with the rent a room, they anticipate you don't need to have the person or anything. You just have to tell them that you would want to rent a room to someone, and that rent is going to be maybe £700, and that £700 could be used as part of your incomes as well to do this. The minimum loan size is 75,000 and the maximum is 300,000 up to 85% LTV. The maximum for 80% is 500. They do also go up to 100% where you don't need any deposit. However, there should be someone to say that they are using their property as collateral for the deposit. So where there's the loan exceed 85%, that is going to 100. then an additional security can be taken against a parent, grandparent, or a sibling's house, provided that the combined value does not exceed 80%. So if, let's say, their mortgage on their property is, let's say, 50% of their home, then they can help you with their security. Yes, that is that. They also apply a 6 times multiplier to your income. Buy for uni. So buy for uni, if you are in uni or your child is going to go to uni soon, you can also help them to buy a place at the town the uni is located, and they can buy 100%. If there's no income, you can join them to buy the property, or you can offer, what do we call it, deposit for them to buy the property. So buy for uni is also something that you can do. So send in any questions. Send in any questions you have. There's also the 5K deposit. What is K? 5,000 deposit. The 5,000 deposit scheme is helping our clients to buy their homes. And the lender accepts a minimum of 5,000 deposit. So the maximum LTV should be 99. Is exclusive for first-time buyers only. New builds are not included, and properties in Northern Ireland is not included. And the loan would be between 95,000 to 495, and the purchase price, the cap is 500,000. The term will be up to 70 years, so 40-year end term. But all the applicants need to have indefinite leave to remain, or they are British nationals. The product is for pre-existing houses. New builds are not included. And at least if it's a joint application, at least one person should have, should be a first-time buyer. First step also is similar to the 5K one, but that one, it gives you up to 98% loan to value. This one, there's no security attached to it. So if you know anyone who wants to go buy a property, so they can put in at least 2% deposit. So it's a lower deposit mortgage, helping first-time buyers buy their homes. And the LTV minimum is 95 and the maximum is 98%. It's 5 years. The maximum loan is 350. So the minimum deposit could be 2% or 5,000, whichever is higher, and must come from your own resources. So gifted, loan, or deposit from third party will not be accepted. So if you have 2% of the property you want to buy, you can buy your property. So this is for you need indefinite leave to remain as well. But note that there are some lenders who do 95% for people without indefinite. So yeah, that is something you need to be aware of. And mostly you cannot, let me say it that way, you cannot combine two schemes. You cannot say, okay, I want joint borrower, sole proprietor, but I want 98% first step. It doesn't work like that. And this one is my first mortgage. So your client would borrow between 190 to 500 with a minimum deposit of 10,000. So if you have a deposit of 10,000, you can buy your home. It's first time buyers and repayment only. It's not available to self-employed, not available on flats, new built or shared ownership properties. If it's a joint mortgage, at least both of you, one of you, it says both clients needs to be first time buyers. We've seen other schemes that said one person can be first time buyers, can be a first time buyer, and it's 4.45 loan to income. The LTV is 95% up to 98%. So whatever it property you want to buy, your 10,000 would have to be at least 2% of what you want to buy. Okay. So this is the end of the presentation. If you want to have more contact with us, our telephone number is 0203 674 2929. Our email is admin@therockfmc.com. Our address, we are based in Woolwich Equitable House, 7 General Gordon Square, Woolwich, London, SE 18 6FH. So this is that. Thank you so much. We'll go to questions and we'll take it from there. Okay, so someone is saying if someone is about 60 years and has been very consistent in paying their rent for the past 10 to 12 years without missing any payment, can they qualify for the track record mortgage despite the age? I need to check if there was a cutoff age. I need to check that and come back to you. But if there's no cutoff age, they mostly need an average of the last 12 months rent. So for instance, if your rent was £800 and it's increased to 2,000, they will take an average of the rent and use that. But anyways, you still need to be able to afford the loan. So yes, if there's no cutoff age, yes, they can do it. It's still subject to affordability, so you can contact us and then we would look into it in detail. I hope that is okay. I'm not sure if you have any more questions, you can ask. Because the schemes are a lot, mostly it's not all of them that is in your head, but yeah. So I have checked and there is not a maximum age limit. You just need to be 21 years or over. So if later you contact us and we know, then we are able to do the affordability in more details. Yes, so it's something that we can look into. I'll bring up our contact details again, and then if you have any questions, you can ask. Okay, thank you, Margaret, for coming on. Thank you. Because I can't see anyone, I can't see the people on. If you are here, if you send something in the chat, I'll be able to know you attended, and that will mean a lot. Thank you. But if you have any question as well, let me know. All right, Timmy, thanks for coming. Gloria, thanks for coming. Helena, thanks for coming. So we said we're going to end at 7:15. So we'll still be here. If you have any questions, then we can answer it for you. So what I've realized is that most of the lenders, they are trying as much as possible to change their policies and their criteria all the time. So know that even with this one, by maybe tomorrow they can enhance it or they can withdraw it. So that is what happens all the time. So even if it said that you need to be maybe this and that, by tomorrow they could have added something. And one of the biggest changes we've been seeing on the market is um, foreign nationals. So before, there used to be the mortgage market limited to indefinite leave to remain and British nationals. And because now there are a lot of, with the health and care visa and all of the things that were introduced, there are a lot of foreign nationals in the UK now that that they um they they need to tap into. They need to tap into. So you are able to have your own property. So years back, you needed 25% if you were not British or did not have indefinite. But now some banks are doing, most of the banks are doing 10%, and some are doing what do we call it? 5% if you meet their credit score, then yes. Buy to let mortgage, is it still at 25% deposit or lenders have relaxed it a bit? Yes, they have. So now there are some lenders doing 20% deposit. So if you have 20% deposit of a property, you can buy your buy to let property. Yes. So it's not a strict jacket 25 now. Now it's 20 to 25. Some, as I'm saying, some do that, and some also they still cap it at 25. Some would do 20%, but they would say that the property needs to have maybe A to C energy performance certificate. So when you find a property and your deposit is 20%, you can check, is free on the government energy performance certificate website, and you'll see where the property lies, and then that is that. If you're supporting your parents to buy your property, if you are supporting your parents to buy a property with you, yes, so you can support your parents to buy. You can, if you still want to keep your first time buyer. I know a lot of people are very particular about their first time buyer something. The first time buyer incentive is basically stamp duties. So stamp duties is tax that you pay when you buy a property. So if you want to buy with your parents, you can own it with them. The age will be limited. Most of the banks will limit the age to the oldest person, but the income, everything can be considered. Some banks can accept three applicants, four applicants on an application and take all their incomes, depending on what the situation is. So if you're supporting your parents to buy a house using your payslip, can you decide that the monthly payment will be taken from your parents' account, though your name is on the property? Oh, yes. When it's a joint application, you decide whose bank account the monthly mortgage will come from. So but the person needs to consent that that is the account that they are going to pay the mortgage from. So any one of you, whether you are four people or three people on the application, just one person would have to nominate their account to pay the mortgage. The other two just need to ensure that there's always money in that person's account to make sure that they are meeting the payment. So that because if there's a default or missed payment, it affects all of you. So mostly joint applications, it is one person's account that the monthly mortgage is taken from. If you have a joint account, then you can also use that as well. But mostly it's one person's account that the the um, the mortgage will be taken from. Yes, I hope this is clear now. Gloria, let me know if it's clear now. And when will you be seen as a second buyer when obtaining a second property for yourself? So if you join them to buy the property and your name is going to be on the, what do we call it? On the mortgage deed, then you are no more a first time buyer. If you remortgage the property and you take your name off the property, you need to wait for about, I think, 3 years or so before you can be seen by the banks as first time buyer. But the stamp duties, I doubt you would be exempted from stamp duties. I need to check this, but yes, you will be a second time buyer if you're now going to buy your own property, a separate property as well. I can see the number of people there, but I didn't see the names and all of that. So if you are here, let me know. I think Gloria, you can give us a call, give me a call, and then let's talk in details about it and all the questions that you want to ask. This one will end at 7:15, so if you can call me straight afterwards, that is fine. Any other questions that you need? Please do not forget to subscribe to our channel. So this is going to be the place we would be doing our webinars. So once you subscribe, you are able to get the notification. If even you don't join, you can watch it later. So subscribe to our channels and we would be in touch more. We have 3 minutes more to go. No other questions. So yes, for first time buyers now, the policies have been relaxed a bit for you. So far as you have income and you have good credit, now things are okay that you'll be able to get so far as you are buying the property. A lot of first time buyers, one thing that hinders the purchase is going for the mansions, the sort of properties we see as a mansion, or the sort of properties we want to have. We want to have at least empty rooms for when people come to visit. It's good. Don't get me wrong. It's good, but that desire to have those empty rooms would not let you start, right? It would let you just wait until you are able to afford that, and then the age is far going, and the properties itself is not also coming down, right? Properties are always appreciating in value. So if you began with what meets your need now, it helps you to be able to begin the journey, the process, rather than waiting to have those empty rooms. And there's always a bargain in terms of you might find a house that meets your need, but the price is too much. And so you might have to compromise on maybe the place not having the biggest kitchen, or the place not having the biggest garage, or the place not having, all those sort of things. So yeah, that is something that you need to consider. All right, time's up now. Thank you all so much for joining us this evening. I hope you had a good time. We hope to see you soon next month in April. Bye bye.